Whatever you earn today has two components to it. One which you have to consume today, and another which is for your future self. So don't eat money of your future self today.
Then you just can't look at your neighbor or colleague and then, just do a copycat of the investments, whatever he has done. My fixed deposits are safe, my mutual funds are not safe, or are they really safe?
Indian investors are in love with fixed deposits. 5 years ago, your salary was the highest. 10 years ago, your salary was the highest. Did you stop working? Go for a goal-based investing. Look at your goal. If your goals are approachable, they are, within the next 4-5 years, start selling.
I mean, if you are at 20, you may want 22% return. So,
Yeah, it's
and
a
there will
rat
always
race.
be somebody who's earned more than you. I mean, there are
course.
people always floating stories that my stock doubled in 3 years or 2 years or 5 years or 20 years. Why can't I put, say, 5% of my money in cryptos?
Get rich quick also means get poor quick.
Welcome to the Investwell Show. In this show, we want to bring personal finance professionals to you who would discuss their experience with investors, investing behavior, and how everyone can invest well. Today, we have with us Mr. Neeraj Chauhan. He's a qualified CFP, AMFI, and IRDA certified planner, as well as a life member of MDRT, which is a group of top professionals in this industry. He's in fact one of the first Indian speakers in the MDRT conference in the US. We'd like to welcome Mr. Neeraj, founder of the Financial Mall, with 3 decades of experience in handling investors and building wealth for investors. And we'd like to just talk to him about his experiences with investors and how people can invest well.
Thank you, Sunil Ji, for having me on the show. It's a pleasure.
Neeraj ji, before we get into the details of investing and investor behavior, just to know, how do you start your day? How do you plan your day? How does your typical day look like?
So the typical day starts early in the morning. Usually we get up from the bed at around 6. It begins with, you take care of your health because, we always preach health is first and wealth is later. So in our Shastras also said that Pehla Sukh Nirogi Kaya aur Dusra Sukh Ghar mein ho Maya. So we take care of our health first and, kind of some walks, sometimes some light exercises. And then we start reading with some newspapers to update ourselves what has happened over the last 24 hours, 48 hours in the country or outside. And once you are up for the day, you are ready for the day. Professionally, the first thing which we do is we have a huddle, which is the office huddle, where we speak to office team members to understand how their day has been yesterday and what is the planning for the day and if there are any issues. So that's what we discuss during the morning huddle. All the work is distributed, what is to be done. So day planned. And then we look at our list of all to-dos for the day, what is important, urgent to need address, and then the day starts. So yeah, that's how it starts.
Right.
The morning starts. Yeah.
Right, that's great. Typically, when you meet your investors or when you come across your first-time investors, what are the conceptions or misconceptions usually you find that they carry and, with when they meet you?
So 2 things here, Sunil ji. First, are they investors or are they just prospects? So we need to understand that. Most of the time, they might be investors, they might be investing with somebody else or somewhere else. So in that case, we need to know why they want to change, why they are coming to us, what is the reason and rationale behind it. Other way is that they are prospects, they have never invested and now they are starting their journey. So both are handled differently. But usually one thing which is common, which I have observed to the investors, is they have some expectations which to my mind is not right. For example, they feel like that investor has some kind of a financial advisor or a planner has some kind of a crystal ball gazing. So they can look at the events what is coming in, or they can kind of tell them the future, which is not right. Another thing which they expect is, once they have a financial advisor or planner on their side, there cannot be any loss to any scheme or any investment, which is I have not observed that in my career. It happens, at the end of the day, we all are humans. Thirdly, when you ask them, okay, why you want to invest, they just go blank. We want to invest, right? What is the logic of your investment? Why you want to invest? Let's set the goals. No, I just want to increase the ROI. I want higher returns. So that's the only sole focus for most of the investors or the prospects. So then you further, ask them, okay, what is a good return? Quantify that good return. And then they said suddenly, oh, what's this question? They don't expect that. And what is minimum risk? I said, in my career of last 30 years, I never had a prospect or a client or an investor who says me, I want to take the maximum risk and the minimum returns. It is always the minimum risk and the maximum return. So we need to actually quantify. So that's another, kind of expectations which they carry. So my point here is that if there is a clarity of thoughts, if they know where want to reach, it is easy for both of us. We as an advisor or a distributor, they as an investor or the consumer of the products. So we both go hand in hand. We understand each other's expectation, and the journey is smooth there.
Right. But from an investor's perspective, I guess this is one of the most difficult things to understand, or to what your expectations of risk or tolerance of risk is, and what your expectation of return should be to align with whatever goals you're seeking.
Yes, technically, it's what you are saying is right. But investing is no different than living a life, right? Day in, day out, you handle that at the back of your hand because you do it daily, right? Similarly, we as a distributor or advisor, that's our back of mind, right? So for us, it might not look that difficult, but for investor perspective, because they are doing it for the first time, they might feel it a bit jittery, right? What are they asking about? What is risk? What kind of a risk? So, if I give you an example, let's say somebody wants to invest. I ask him a simple question. Let's say we are sitting in Gurgaon today, right? And we have to reach to maybe Connaught Place in Delhi. And, right now, the time is 11:15 and we have a meeting at 2:33. I have a choice of transportation, right? I can take a metro, go. I can take a Uber and go. I can take my own car and go. I have choices. But what if that appointment is at 12 o'clock? Do I have the same options? And particularly if that meeting is very, very important, right? It's a good business deal. I have to take my own car and move because I want to reach there faster, keeping some margin of safety. So is investing, right? If you have that kind of investable surplus, wherein without taking any risk, you can invest and still meet your goals. But on other hand, if their goals are such that you may have to some calculated risk, then you have no choice. So that's one way of risk profiling. Other way of risk profiling is as we does, in our instruments, you ask certain set of questions to check out. And ironically, that also changes with the market swings. When the markets are bad, suddenly you file the same question and the answer would be moderate or conservative. And when the market are booming, the same investor set will give you a different set of answers. And it could be leading you to observation that, okay, he's aggressive or maybe moderately aggressive. So I think with a pinch of salt, if you just don't be very serious about subject investing, don't go very technical and relate it to the daily events of your life, of the nature, then you have easy answers on your table.
Yeah, but then what I get a gist from your conversation is that this is something very personal. It will vary from person to person. I mean, your risk profile may have segments like conservative, moderate, aggressive, etc. But then this is still very personal to what the investor wants and at what time he wants, at what pace he wants. So this is something which will be different from each person to person. You just can't look at your neighbor or colleague and then just do a copycat of the investments, whatever he has done.
Absolutely. That's why it is called as personal finance. Yeah. So each individual is different, right? Each individual's habits are different. Be it a eating habit, be it a games habit, or whatever habit you want. So is it in investing, right? You can't just copy your colleague because their financial status could be different. Their financial preferences could be different. They might not be losing sleep with the volatility, but someone else might be, not feeling very happy about it and be stressed because market has fallen. So yes, it is very, very important from the client's point of view to understand their behavior towards money, their behavior towards the risk, their understanding of the risk. And that's where the hand holding of an advisor is very, very important, because when you start working with the client over a period of time, because it's not on day one you just filled in some questionnaire and you get to know you label him it as aggressive or you label him it as moderate. That's not the way to do it, right? In a span of year or two, you start getting a sense of that client, how he behaved when the market fell, how he behaved when some of the scheme didn't perform, how the family culture is, how the cohesive and other aspects of money in their family. So over a period of time, you get a sense and then you handhold them. Okay, this is right for you, this is not right for you. Okay, sometimes you have to push. Okay, we can take some risk here because you have the understanding of the market a little more than the client. So definitely that's when you mentor them. Just another example which I will give you. Today morning, it was raining and we had to shoot this postcard. So what I texted you, I said, Sunil ji, here it is raining, what do you say? Why? Because, I could see a lot of water logging around me. But then you said they have moved out, the team has moved from Noida. So I said, oh my God, they're moving from Noida and I just have to travel few kilometers. So as a mentor advisor, you just pushed me a little. And I said, okay, fine, nothing doing. It may be a waterlogging here, but going forward, I know the roads are okay. And we are here doing this podcast. So that's where the role of advisor comes. Sometimes you have to give a little push because the client might not be willing to take that risk. But if you're taking that calculated risk, we need to take that to help the client meet those goals.
So it's a lot of learning about the investor and knowing his psychology, and then kind of giving him back in a shape that he meets his objectives or goals, whatever he has set together with you, I guess. Let me ask you one thing. How do you coach your investors into, how to look at their portfolio over time? Because, when they start with certain discussions with you. But over a period, at what frequency they should look at their portfolios? How should they reassess their goals? So is there a kind of process that you follow where you just meet the clients often, and how does it work out?
We all are so tuned to speak about what should they do and how they should do it. But it is equally important to understand what they should not do. And the first and foremost thing in this is they should not look at their portfolio daily. And, which is most of the time investor does. No matter how many times you coach them, you tell them. One fine morning, I got a couple of calls from my investors saying, Neeraj, tera app nahi chal raha hai. And then I suddenly called you, sir, kya hua, app nahi chal raha hai? And I called up client, sir, I'm telling you, don't look at it daily. And he says, no, this is my daily routine with my morning cup of tea or coffee. I want to see it. It gives me a kick. So that's how, the behavioral aspects of the client. And as you rightly said, in investing, it is 90% of the behavior and 10% of the knowledge. And we need to understand that. It's easier said than done. Even today, we have challenges when we speak to client. Some clients are slowly and gradually maturing because they have seen a lot of volatility, ups and downs in the markets. They understand the schemes underperform sometimes. There are short legs like that. But at the end of the day, it's okay. So it's more of a challenging to the new investors, those who onboard in last 1 or 2 years or 3 years, because the older clients, they are tuned to it. They are kind of educated, coached enough with some kind of regular communications, interactions. So when the client come on board and he gets jittery because of the market, 3 things. One, you have to be rationally tell them why it is happening, the background, and how it is going to affect them. So if they have goals, that's where the goal is very, very important. If the goal is, let's say, 10, 15 years down the line, you don't have to be worried about it. But if the goal was 2, 3 years down the line, then the first thing which is wrong is that you have given a equity instrument or a risky or volatile instrument to them, which should not have been the case, and that generally doesn't happen. And this is a double-edged sword. You know why? When the client doesn't understand the goal planning and doesn't understand the difference of giving an asset for a short term, medium term, or long term. In short term, you are giving him an instrument which is kind of safe, conservative, right? Which might not deliver a kind of return which equity delivers. And then he starts comparing with his colleague's portfolio. Oh, his portfolio is doing this much, mine is doing lesser. Why? And you tell them, no, you are conservative because you have a goal approaching. You say, no, it's okay. I want to take more risk. You say, no, I can't give it. And classic example I would give you. Recently, a client called up saying, why I'm sitting on this? And that was a contingency fund. I said, this is contingency. Then it's okay, I don't need contingency. And I want aggressive returns because the market has started doing well. I can't give you aggressive. This is not what I feel right for you. No, you give me, I want it, this is my money. I said, fine, fair enough, this is your money. Just do one thing, give me a mail. Write it down that, okay, I understand the risk. I am willing to take that risk. Please give me the most aggressive scheme. I'll give you that. Once I put that ball into his court, so he has to own it. He has to own that decision now. He has not given me in writing. And then, okay, I'm fine with it, whatever you're saying. So sometimes you have to put the foot down and you have to coach them. Okay, this is, I understand. And other way around, you have given it for long term. Market policy said, nahi, aapne debt kyun nahi diya, usme to risk nahi tha. So gradually, slowly and gradually they learn, they understand the maths, they understand the behavioral part, and they kind of get settled. So you need to coach them regularly something,
I guess
give them some piece of information, give them some story, give them some facts and figures, give them some kind of write-up. So it's an ongoing process. We are still learning it.
Yeah, I'm sure. I guess this must be more with the new investors that, in the first few years, they would have this anxiety of comparing with the market or comparing with their colleagues and then coming back to you saying, why doesn't it work out for me the same way? So I'm sure with time, probably they settle down and understand their own, needs and probably tolerance to the risks, I guess so. Yeah.
And another issue which most of the time comes is changing of goalpost.
Exactly, yes.
We all understand that Indian investors are in love with fixed deposits. And as a first time investor, when you tell them why are you here, you can have a better risk reward returns and the tax efficient returns outside fixed deposits, they start coming to it. And we ask them, okay, what is your expectation? They say, FD jitna mil jaye bina tax ke, I am happy. And when they start getting more than that, they start saying, oh, why it is giving only this much kind of return? And then I said, okay, let's go to our day one conversation. What was your expectation? No, but someone from another distributor or advisor is telling me your advisor is not doing right. You see how much market has given a return, and your portfolio is just giving this much.
Exactly.
So we need to understand that, okay, what is your objective of that investment? What was your goal on day one? If you were comfortable with lesser risk but return which is more than fixed deposit, post tax, having real return positive, and you are getting that. But then don't be greedy.
Exactly.
Yeah. So as I said, it's journey in progress. I hope we'll continue with this.
Yes, I think so. Actually, one thing, most of the seniors that I talk to over 60, 65 age, they all mention that, I am comfortable with my fixed deposits.
Yeah.
And whenever they have a sum of money, at least 50% of it goes towards fixed deposits, and the remaining 50 probably they think about investing elsewhere. So, do you get this question typically as to my fixed deposits are safe, my mutual funds are not safe, or are they really safe? Do you get this type of question, especially from the people in the higher age bracket?
That's a pretty common question, and we get these kind of questions day in, day out. I would only say one thing. You understand, because there is a concept called as real return, right? And when they're comfortable with fixed deposit, comfortable doesn't mean good. Comfortable means that you don't want to get out of your comfort zone, and you are compromising returns for that, and you are eroding the value of your money without taking risk. So it's a short loss recipe, right? For example, if the inflation rate is, let's say, 7.5, 8, because generally that is the kind of lifestyle inflation we are in. So if that kind of inflation is there and your fixed deposit is getting you the same return, 7.5, 8, let's say both are equal. But then on 7.5, 8, you are also paying taxes.
Exactly.
10, 20, 30% based on your slab.
Yes.
So what is happening? Gradually, your value of money is depleting.
The purchasing power is...
Yeah, you are losing that purchasing power and you are not taking any risk.
Yes.
So, we say mutual fund is risky, but then it has upside potential also. Over a long period of time, it has proven itself to be a better real return positive instrument. So we need to tell them, of course, you have to keep some money as safe, or maybe you can keep that money for your next 2-3 years ka kharcha to live your lifestyle. So have buckets. So we need to tell them various strategies, how they can have the best of all.
Yes.
Rather than just sitting there comfortably and see the money losing.
Exactly. Yeah, it's sometimes not good to just leave it as it is and just do the default, which is like put it in a fixed deposit. You need to probably think better and plan.
देखिए, बच्चा चलना जब शुरू करता है तो गिरता है ना, बट इसका मतलब ये थोड़ी हम उसको कहते हैं बेटा चल मत, बंद कर दे चलना.
Exactly.
राइट. सिमिलरली जब साइकिल चलाना शुरू करता है तो गिरता है. क्या हम बोलते हैं नहीं साइकिल में चला गिर जाएगा? So what you do is you handhold them, make them walk.
Right.
You help them to slowly cycle, right? And then just leave them so that thoda chale.
Exactly.
That's how we have to handhold them. ठीक है, थोड़ा करते हैं. Let's do it with 10%.
Right.
Just understand what kind of a risk, and it is not risk, it is a volatility, and understand the difference between the two.
Exactly.
So at the end of the day, as I said, it is behavior. So you have to just tweak a behavior slowly and gradually, so that they understand the difference between the two.
And each human being is different. So this must be a continuous exercise or a game for you.
It's
where you keep learning and you keep coaching every new individual.
Yeah,
because he will have a different outlook towards the same thing.
Definitely, yes.
Exactly. One more thing. Typically, investors always ask, once they are convinced that yes, okay, I can invest, I should be investing, is the market too high? I mean, if you look at the current situation, probably both the indices are at all-time highs. So this is again a question in investors' mind that is the market too high? Let me wait a bit and enter maybe at a correction or something. So how do you address that?
So, Sunil, there can be technical answers to that and the simple answers to it. Some people say it's all-time high. I would say it's still time high, right? 5 years ago, your salary was the highest. 10 years ago, your salary was the highest. Did you stop working?
Exactly.
Right? You keep on working and then you reach to a higher salary. So is the market. Is the economy stopped working? Is it not growing? So will the market not grow? What do you expect out of it? Then just a number, looking at a number and saying that market is high is incorrect. There are various parameters to look at it. If we look at the language of investing parlance, right? You need to look at the GDP to ratios, right? You need to look at the P ratios. You need to look at the PB ratios and various other parameters which are indicators, right? From the valuations point of view, I'm not talking about the market is high. We have to shift that from that number to the valuations. Are valuations really high? Is economy growing, or it is staggered, or it is going to go down from here? If that is the outlook, of course you have to be cautious. But if that's not the case, just by going a number is not a right way to look at it.
Yeah, I guess so. another thing which investors normally would think when the markets are at these kind of numbers is, should I do some profit booking? Should I sell, say, 20% of what I own and then again come back? I mean, that's one feeler that I also typically get at times, that why not try and do this timing.
So there are a lot of data which are floating around. If you look at, I think day before yesterday, I also got some WhatsApp which says that over last 10 years, if you have missed 20 days, last 10 years and 20 days, you are not even getting a FD return.
Okay.
Right? So you mean to say that as I started the postcard saying that most of investors expect us that we have some crystal ball gazing. No, we don't have. So we don't know how market is going to behave, because market is irrational in a short term, though it is rational in a long term period. But if you sell today and the market runs up, you lose it. Right?
Exactly.
On the other way around, if you don't do it and market falls, you again lose it. But you cannot time the market. Let's keep it plain and simple. And if you are trying to time the market, you are going to lose. Secondly, if I look at the behavioral aspect of it or the psychology part of it, if you have sold it and the market goes up, you are confident. Oh, I took a right decision. See, I was the intelligent man on the universe. And market goes down and down and down. And you say, wow, I made it. And then the market turns. No, it is going to fall further. I'll invest. Wait, I'm right. And he loses the entire opportunity of that U-turn. And this has happened during the COVID period.
Yes.
A lot of investors who could take the right sell call couldn't take the buy call. Right?
Yes.
And it is very, very tough to tell yourself, guy, I am stupid. It's not easy.
No one wants to agree to that.
It's not easy, right? And then they lose it just for sake of their ego. So that's where we need to understand, we have to be rational.
Yes, if you have sold at a particular price, then you just want to wait till it goes down, and you just keep losing the opportunity.
You can't do it, right? Exactly. And if market goes up and you have sold it, right? You can't buy the same thing at a higher price. That's again a psychology. You sell some stock at, let's say, $200 and the stock goes $300. You cannot buy it again because you sold it at 200.
Exactly.
So these are the psychologies, and I don't understand this. I don't advocate that. I would say go for a goal-based investing. Look at your goal. If your goals are approachable, they are within the next 4-5 years, start selling. Go conservative, right? Because for me, the goal is paramount. That is very, very important. My happiness is if I achieve my goal.
Exactly.
Someone's child has to go to US for studies. For him, market doesn't matter. What matters is on the right time, I have money in my bank account to support that education.
Correct.
And that is going to give me happiness. No matter market goes up 10%, 20% of year, that's a temporary happiness.
Correct.
So we need to look at the goal-based investing. If that is there, most of the time, you will not take wrong decisions.
Yeah, the expectations should be on meeting the goals rather than on achieving higher and higher returns, because that number is always, if you're at 20, you may want 22% return. So, and there'll always be somebody who's earned more than you. There are people always floating stories that my stock doubled in 3 years or 2 years or 5 years or 20 years. It became 20 times. So there'll always be somebody who might have got a better return.
So as people say, and it's a rat race then.
Yes.
Right?
Exactly.
And no matter whether you win or lose, at the end of the day, you are a rat.
Exactly.
So if we are a goal-based investing, you'll have your nerves checked, right? You will not be stressed, and you will feel happy about it. And at the end of the day, money is nothing but a source of fulfillment of your dreams and goals.
Exactly. Money should be the way, it should not be the target.
Of course.
It should be allowing you to proceed in your journey. That's very true. One more thing I would like your opinion on. A lot of young investors want to invest part of their money in cryptos.
Okay.
Do you get any such interests from your clients that why can't I put say 5% of my money in cryptos?
Yeah, lot many. And the irony is when I ask them, okay, how much of your portfolio is in equity? No, I don't want equity. I just want crypto because we want a get rich quick scheme,
Yes.
right? So I said, get rich quick also means get poor quick.
Yeah, but no one wants to see that part of the story.
Yeah, but they don't want to see that kind of a story, and they just put money in, and some have burnt their fingers too. Anyways, yes, you can do your crypto if you want to do it, but it's not good to put your entire stake there. Maybe 5-10% is okay. It's take a look at that money as your play money and
Yeah.
play with it, understanding couple of risks which are there, because that is very important when you invest anywhere. There are many risks. First of all, it is not regulated across the world, so you can't go and cry in front of anyone if you lose money or if you lose your shirt there. In equity, you can always cry and you can always go to SEBI or other regulators if there is some wrongdoing. Then there are hackers around, they hack your account and one fine morning you feel that everything is gone.
Yes, since it's all digital.
It
Yeah.
has happened, and the risk is very, very high. Does it make sense to carry that kind of a risk to earn that kind of a return? What is going to be the end use of your crypto? So there are various questions to answer before you take a plunge and start investing in crypto. Don't just go by the returns. Understand the risk with it. Once you understand that, and then take a call. I would say 5-10% is okay, but just don't lose your shirts there, right? By putting all your money here.
Yeah, but even a 5-10% exposure, if something goes wrong of that magnitude where the founder of the crypto is himself missing, then probably you're losing the entire return on your entire other portfolio as well.
No, I would take it differently, because at the back of the mind, those investors are also know what is going to happen, right? So they are not coming here for the returns; they are coming here for the kick. And you can't go and tell a young guy or a young chap, oh, don't take it. It gives me a kick, right? So you need to very, very clear: are you here to create wealth or the net worth, or are you here to have a kick? Let's differentiate that.
So if the goal is
If the goal is-
appropriate, then it's okay.
Then it's okay.
Yeah.
At the end of the day, it's your money.
Yeah, you can't always say no to something because he's not going to agree.
Yeah, they will not agree because anyway, youngsters, we know better. You have an old thought process, you have an old mindset. Recently when Warren Buffett was not doing good, people started raising fingers, right? That gentleman who has shown the word of value investing and how to create wealth, or he knows nothing. It's just by fluke he made that kind of a wealth and net worth. So if people can raise finger on him, who are you and I?
Exactly. In the end, any quick tips you would want to give on investing to these younger generation people mostly? Because the older ones usually have learned over a period and probably they need extensive help if at all. But the younger ones who are beginning to invest, anything you would want to mention to them?
Investing is boring. As it is said, investing is just like watching the grass grow or looking at the paint drying, right? It's boring. It's not exciting. So don't look for excitements in the investing. They are old thoughts, but even today they are the proven ones, that if you maintain a discipline, if you maintain a consistency and let the compounding do its job. So the biggest taker here is the compounding. Avoid pitfalls, avoid doing mistakes, because one mistake can be a costly mistake. Avoid that. Don't just look at 20%, 30% returns. As long as you are getting real return, positive, decent return, you are creating alpha of 4-5%, you are going to create wealth. ठीक है, तो सबसे पहली बात, खर्चा कम, इन्वेस्टमेंट ज़्यादा, इंस्टेड ऑफ डूइंग आमदनी अठन्नी और खर्चा रुपया. है ना? So that is the challenge which we see with a lot of young guys spending credit cards. With credit card you don't have emotions attached to it, because swiping a card for 1 rupee or swiping a card for lakh of rupees has the same emotion. On the other hand, if you give cash, 1 रुपया और लाख रुपए देने में फर्क पड़ता लगता है. So if you just follow these basic principles of starting early when you start invest, let the compounding work for you. Don't disturb your compounding, and 20% of your money first, let that be invested, and balance 80% you do whatever you want to do. If you do that, I think the life financially is sorted, and you will feel happy, not today but later. And one important thing which I generally tell to students when I go and speak to them, the concept of your earning today. Whatever you earn today has two components to it. One which you have to consume today, and another which is for your future self. So don't eat money of your future self today. That's very important. Otherwise your future self will cry.
Exactly. So you have to balance.
You have to balance it out.
These expenses vis-a-vis the planned expenses for future.
Yeah. And don't spend your unearned money by borrowing.
Exactly, because borrowing has become easier, but then it gets you into a trap after some time. Thank you so much for your thoughts. We believe some of these, if people follow they should be investing well rather than, thinking too late as to what they have not done.
Thank you so much, and I wish all investors invest well.
Thank you, Neeraj ji. It was a great session. That was it for today. If you would have any questions, please feel free to put them in the comment section. We would try and address them in the subsequent sessions. See you all in the next session. Till then, invest well.